Hey guys, it's Sasha. The US Consumer Price Index for August clocked in at 8.3%, with August seeing a 0.1% increase from July across all items. This was significantly worse than what the market was expecting, because the market consensus was for US inflation to be at 8.1% year on year, expecting a second drop in a row. And there was a drop in the overall number from 8.5% in July to 8.3% in August, but although the headline number has decreased, in reality inflation has gone up, because inflation is a relative measure. And for some completely unpredictable reason, inflation has not gone away all by itself for the first time in history. Who could possibly have predicted that in videos for the past year? The problem is that under the bonnet, the situation is only getting worse, and this is part of the reason why the markets took a dive this morning. Because you can see that energy dropped by 5% in August, the second big drop in a row after July. And the popular narrative with inflation up to now has been that energy is the sole reason that inflation has gone out of control. It's all Russia's fault. You know, it has absolutely nothing to do with printing the biggest amount of money in history during COVID and then refusing to start increasing interest rates when inflation numbers were climbing up all the way through last year, because, you know, inflation was completely transitory. The Fed applied the ostrich sticking its head in the sand approach to managing the US economy, and here we are. The big driver of the drop in energy is oil. You can see the gasoline and fuel oil are both down over 10% month on month. This is a really big drop because oil prices peaked back in June but have been steadily declining ever since, and oil is now trading at about $89. Unlike gas, oil is much more flexible as a commodity. You don't need huge pipelines to go and deliver it, and although the price is still historically relatively high, the initial effect of the sanctions is now wearing off, as Russia is now selling more of its oil at discounter. India, China, Indonesia, and other countries, and all the rest of us are buying oil from other sources. Global leaders have recently agreed to place a cap on the price of Russian oil in the global markets, which is due to take effect on December 5th, although we still don't know the exact details, the exact pricing, because the G7 is busy trying to convince China and India to join in. But even if China does not join in, the likelihood is that China will then have more leverage in their side deals with Russia, potentially getting a further 30-40% discount off the market price, which is declining itself, which will probably net out at something similar. The US is continuing to use its oil reserves, dropping those to the lowest level in 38 years, which is helping push the oil price down as well. But there are still 442 million barrels of reserves remaining as of the week ending September 2nd, and the US may well decide to continue releasing their 1 million barrels per day well past the October deadline because they have enough leeway. Now, going back to the CPI report, gas prices remain relatively high, and so electricity and the gas part of the energy mix within this index has gone up by 2.1% overall. Gas prices remain extremely high, and a few days ago Russia shut down Europe's main gas pipeline, Nord Stream 1. The markets appear to have already baked this into their forecast because the gas price has fallen slightly since the August peak. It is still unclear as to how this Mexican standoff between Russia and Europe will end, because Russia can't sell this gas easily anywhere else because they don't have pipelines connecting those gas fields to China or other countries. There are only so many facilities that can produce, store, load and unload liquefied natural gas, and only so many tankers around the world that can transport it. Given that winter is coming in Europe, the pressure on gas prices is likely to remain high, which will continue pushing inflation, unfortunately, until April next year, when we start looping the post-war period when the prices started going up. The big problem with inflation is when you begin looking at everything else in here other than energy. Food continues soaring through the roof even as oil prices are on the decline. Food at home is up 0.7% month on month, and food away from home is up 0.9%, continuing the trend we've been seeing in recent months. This is a massive increase. The 12-month increase for food at home is now at 13.5%, and this is becoming a really, really big problem. The sort of problem that an occasional 50 or 75 basis point increase a few times a year along with a hope and prayer is not going to solve. If you take out food and energy, the core index is also up above expectations, going up 0.6% in August for a 6.3% annualized figure. And the scariest part of this report is something that I've been highlighting and reporting on repeatedly for several months now, and that is shelter. Shelter is the cost of accommodation, the price of rent, and mortgages that people pay to live in somewhere. But shelter is a massively delayed metric in the CPI report because it is not based on actual real data. It is not based on the amounts that people are paying. It is not based on house prices, but instead is based on surveys. As rent prices and mortgage prices explode, it takes some time for people to take note. If you're in a fixed-term rental, you won't feel the full impact of these increases until you come to renew or maybe move house. If you're in a fixed-type mortgage, which is what most people in the US have, you won't feel the real bite of increasing costs until you move and take on a new home loan. Shelter makes up 1/3 of the total index, and it has just gone up 0.7% to 6.2% year on year. So 1/3 of the index has just gone up 0.7%. The rest of the index is generally also going up, and energy dropping is the only reason why that inflation number hasn't gone up above 9% in the last 2 months. But the problem is that this is still lagging, the shelter number is still lagging behind what's actually happening in the world of rent and house prices. The Zampa report has seen a drop in rent costs in July and August, but we're still looking at a 10 to 12% per year increase every single month. And these high increases have already been happening for the last 12 months, while the shelter figure in the CPI index has been considerably lower. And the all transactions house price index data has just come out a few days ago, and in that data, prices increased by 7% in Q2 versus Q1. That is insane. And yet the shelter number in the CPI index is still lagging way behind, and this means that the shelter number will continue, unfortunately, pushing upwards every single month when we see this data, as it has a long way to go to catch up with reality. And this is going to make the objective of stopping inflation through increasing rates by the Fed way harder. The Fed's next meeting is scheduled next week with an announcement on rates and monetary policy due on September 21st. Jerome Powell gave a speech a few days ago where he said that fighting inflation is the #1 job for the Fed, and the Fed will increase rates despite whatever it might mean for the markets. Well, I guess we shall see next week whether he actually means it. The European Central Bank, that is known for being very slow and conservative, increased their rates by a record-breaking 75 basis points 4 days ago. And it might take more big increases in the US for the increased rates to start having the necessary effect on killing demand to drive the inflation numbers down. The last 2 meetings by the Fed produced increases of 75 basis points, but the rates are still at just 2.5%, a historically very low figure despite these increases, which is way below the current rate of inflation, and history and basic economics say that the rates will need to go to at least the same and most likely above the rate of inflation to start exerting a significant downward pressure. The problem for the Fed is that they have dallied for too long. They've been sitting around twiddling their thumbs, not doing anything, while everyone was telling them that maybe they should take some action. And the even worse problem is that the longer that they continue to dally, and unfortunately they're continuing to dally while inflation is at 8.3% and the rates are at 2.5%, the longer that continues, the worse the problem is going to get. If they start increasing the rates too quickly, though, it will significantly impact the cost of credit, the cost of borrowing by companies, a whole load of stuff will destroy demand to a point where the US economy can fall into a very sharp and very dangerous recession, or worse. Gas prices are likely to stay high for some time. Europe is now actively planning for the rationing of gas and energy this winter, potentially telling commercial clients to use less, stay off the grid during busy hours. Oil prices have already come down, but the inflation spiral has now taken hold so bad that the inflation is not falling even as the price of oil is back under $90 and even as the price of energy is dropping for 2 months in a row. It is becoming increasingly likely that the Fed will need to take drastic action because there are only 2 more meetings scheduled for this year after the one coming next week. Unfortunately, the Fed is also stuck politically because as late as October and November last year, Jerome Powell was still proclaiming that inflation is transitory and there is absolutely nothing to worry about. It seems a lot longer ago now, doesn't it? So going for a 100 basis point increase in September, as some analysts in the city are actually predicting, would be a very big admission of getting it very wrong, but that is maybe what they are going to have to do. That is what it might take to stop inflation running to above 10% this winter and setting off some major panic alarms in the global financial markets. If you found this video useful, please don't forget to smash the like button for the YouTube algorithm. Thank you so much for watching, I really appreciate it, and as always, I'll see you guys later.